good afternoon, everybody. My name is Stefan Burchard. I am your Vice Chair for the California Desert Association of Realtors Young Professionals Network Committee for 2021. First of all, I want to thank you all for being here. This is our very first meeting, and this should be a real fun year. Hopefully we'll have a hybrid of Zoom events as well as live events later in the year. Let's cross our fingers. Let's cross our fingers. Anyway, today we're just going to get right into it. We have a CPA who was recently voted Best of the Desert for 2020. His name is Kevin Rotenberry with Padgett Business Services. I've known Kevin for over 5 years now. He's a consummate professional. Kevin is a CPA with over 25 years of experience. He is licensed in California and Ohio. Kevin has worked in public accounting for 10 years before leaving to be a CFO for several medium-sized companies. In 2012, Kevin returned to public accounting by opening his own firm with Paget Business Services in Palm Springs. Paget Business Services specializes in small businesses that are owner-operated in the service and retail industry. He also works with individuals to make sure they are paying the least amount of tax legally possible. It is my distinct pleasure to introduce to you Kevin Rotenberry, my CPA and friend. Kevin, take it away.
Thank you, Stefan. Hi, everybody. I know you can't respond back to me, but it was a great opening for me. And Justin, you're going to share the slides, right?
Yep, that's correct. I'm going to start my screen now.
And you can go forward. Stefan already has given you a little bit of my background. I've been, Paget is actually a franchise, just my business is, and that Paget is headquartered in Athens, Georgia. They've been around for over 50 years. We've got over 250 offices in the US and Canada, and we specialize in small businesses in the service and the retail industries. We are owner operated, and we usually have we usually take care of people with less than 25 employees. So you can go forward, Justin. Keep going and going. Okay, personally, yep, that's fine. We'll just skip over that. We have a lot of information to cover today, probably more than we have time for. So I'm going to kind of go through it pretty quickly, and then we can take on some questions for anything that people have an interest in. Go ahead and go forward. This is just the services I offer, but you don't need to know that. This is just a little summary of the topics that we're going to discuss today. You can see automobile deductions, meals and entertainment, home office deductions, gifts, personal residences, gain exclusion, converting personal residence to rental properties and vice versa, rental properties itself, those nuances that relate to that, like-kind exchanges, the CARES Act and other COVID laws, and the best entity choice to operate your business as a real estate agent, and then just a few miscellaneous things if we have time to get to those. So one of the most common questions I get as a CPA is, how do I take an automobile deduction? And there's multiple ways to do it. So the first question you have to answer yourself is, who owns the car? Is it you, the individual employee, or is the business the one that owns the car? And then you have to distinguish between your miles, between business miles, personal miles, and commuting miles. The personal miles and the commuting miles are not deductible. The only thing that's deductible are business. And by business miles, what we mean is miles that were driven from your either temporary office or your permanent office to a business location. So for example, if you have a business office that you go to daily, your trip from home to that permanent business office is non-deductible miles. However, if you stop at the bank or you stop at a store or the post office before you go to the business office, that now makes that mileage deductible. And so you do need to track those three things. That's something that the IRS will ask automatically if you ever are audited for your travel mileage log. Down below here is what's needed in that mileage log. There are some apps that will track it for you. I've mentioned a couple, 2 or 3 that clients have are using that they like. But what those logs should include is the date of the trip, the purpose of the trip, and any clients that you are dealing with, and then the number of miles that are driven. And then those apps or your personal mileage log will add up, and you'll have your business, personal, and community miles. And that's what your CPA will need in order to take the proper deduction for you on your tax return. So there's two ways to take the deduction. As I mentioned, you can either take the standard mileage rate or you use your actual expenses. The mileage rate for 2020 is 57.5 cents a mile. For 2021, it's actually dropping down to 56 cents a mile. And that is driven by the consumer price index and inflation, how they determine those rates. So you have to either take your business miles times those rates to determine your deduction, or you can take your business miles divided by your total miles to come up with a percentage, and then multiply your actual expenses by that percentage. One of the things that the IRS required, though, is that once you put a car into service, you choose a method. You either use the standard mileage method or the actual expense method. And as long as you own that vehicle, you have to stick with that same method. Next slide. Below are just some of the actual expenses that would get included in that calculation. Any lease expense, depreciation, interest expense, your gas expenses, insurance, and maintenance. If you're doing the standard mileage rate, it's assumed that all those things are included in your 57.5 cents per mile that you're driving for business. Next slide. Next thing we're going to talk about is meals and entertainment. The most important thing is that they should be ordinary and necessary. That's a tax buzz line to make sure that it is appropriate to be deductible. If that is true, you include your cost of your food, your beverage, and tax and tip. Everything gets included. Next thing is, and starting with 2018, the new tax law, entertainment expenses are no longer a deductible expense. So the days of taking your clients to a ball game or to the theater or any other kind of entertainment, even to the out to a bar or a show or anything, no longer deductible starting in 2018. Only meals are. Your meals with coworkers and associates are not deductible unless you can establish a clear business purpose. So just going to lunch and just getting away from the office for an hour is not a deductible expense. However, if you talk business during that lunch and document that you talk business, then it can be deductible. Meals deductions are limited to 50% of the cost that you pay for 2020. However, the new law that just passed in December 27th allows 100% deductible. Go ahead and next slide, Justin. For meals are to 100% deductible for years 2021 and years 2022. This is something new. The goal was to get more money into the pockets of the restaurant people who are hurt by COVID. So that was the reasoning to make that change just for those 2 years. You do need receipts, and to document the deduction, what you should document on those receipts are who was there at the lunch, what you talked about, where you went, and why you had the lunch. Meals paid by an employer for the employees are 100% deductible as a fringe benefit if it's for the employer's benefit, not the employees. So for example, holiday parties, summer picnics, those types of things that are paid by the employer and all employees are included in it are a deductible expense 100% for the 2020 year. Next thing we're going to talk about is home office deductions. It's easier to take this now than it has been in the past years. There are the space that you use must be exclusively used for business. Go ahead forward, Justin. So if you have a bedroom that's exclusively used with a desk and something that could be used, that's an okay deduction. However, you setting up a computer on the corner of your dining room table would not be an appropriate home office deduction. There's 2 ways to take a home office deduction. There's a simplified method and an actual method. Under the simplified method, you can just take the square footage of space that's used exclusively for business times $5, and you can do that up to 150 square feet. So you'd get a $750 maximum deduction under that method. Another alternative way is to take your actual expenses, which you take the percent of the space used for business of your total home times your actual expenses. And those actual expenses include your mortgage interest, real estate taxes, rent if you don't own, utility bills, any kind of expenses, maintenance on the house, any of those things would be multiplied by the percent of the space used for business. Just before you go back 1 second, just a little caveat there to warn people, the home office deduction also allows you to take depreciation on your personal residence. However, I always warn my clients that if you do this, there is depreciation or recapture when the house is sold. So normally when you sell your personal residence, there's a $250,000 exclusion of gain. However, if you've ever depreciated your house for either rental property purposes or your home office, you do have to recapture that depreciation. So I tell people not to take the depreciation aspect of the home office because it's a very minor amount, considering that you're going to have to recapture it later when you go to sell the house. Go forward. Next thing we're going to talk about is business gifts. Very little known rule is that gifts to customers are limited to $25 per year per person. It's a very low number. I understand it's been around for years. The IRS and the Congress has really showed no interest in changing it. But it is a very small number and people are probably giving more than that and deducting them. You can give more than $25 in a gift to people. And I'm not talking cash, but just the value of the gift. However, the excess amount over $25 are not deductible. Go ahead forward. One way around this, go ahead, is to put your name or your logo on the gift that you're giving to the client. So that would become an advertising expense rather than a promotional gift. So as long as your name or logo is on the gift that you're giving out, 100% deductible, no problem. Just want to make sure everybody's understanding this is not to be confused with the annual gift exclusion of $14,000. That is not taxable or deductible. That is a whole totally different subject. This is just business gifts. Going forward. Next thing we're going to talk about is gain on the sale of personal residence. I kind of alluded to it just a few minutes ago. Individuals get to exclude $250,000 in gain from the sale of your personal residence. Married couple would get up to $500,000 in exclusion. However, so the house must be owned and used as a principal residence for at least 2 of the last 5 years prior to the sale. And you can take this deduction every other year. So every 2 years you can use it. So if someone is willing to move every 2 years, you can take it. And if you're not there for the entire 2 years of the 5 years, you can do a reduced exclusion amount of the $500,000. You don't have to, if you're not eligible for the whole thing, it can be prorated. All right, next thing we're going to talk about is converting property. So if you have a property that you're either is going up in value quickly or going down in value and quickly, you may want to consider either converting it from a rental property to your primary residence, or if you have a house that's going down in value, moving it from personal residence to a rental property. And why would you want to do this? Losses in personal residence are not deductible, but the business losses are allowed. So if you have a house that's going down in value, you could transfer it over to become a rental property and then take the loss when you sell it. And just opposite of that, if you have a rental property that's going high in value, you could move into it and live in it for 2 of the last 5 years before you sell it, and then use that $500,000 gain exclusion to avoid paying tax on the increase. So one way to do it, just make sure you consult a tax advisor on the rules of it. Next thing we're going to talk about is rental activities. Everybody thinks rental activities are a wonderful thing, but there are some particular rules that relate to it. For most people, rental activities on houses are passive activities, meaning that the person that has a rental activity has a normal job that they go to, and they don't spend a whole lot of time managing the property. And when that situation is in place, it's called passive losses or passive activity. And so when you have a rental property, most likely you're going to have a loss on it when you consider depreciation. It might cash flow positive, but when you take off the depreciation expense, it could be a loss. And for passive activity, losses are limited to $25,000 on your personal tax return to deduct. However, if your income is above $150,000, that $25,000 loss that you want to deduct isn't deductible. So as long as your income stays below $100,000, it's no problem. You can deduct it all. If you're between $100,000 and $150,000 of taxable income from other sources, it's phased. That $25,000 is phased out. If you do have losses that you can't deduct, and they're carried forward to future years, they're not lost, and to the point that you have income from it, or when you sell it, then you could deduct the losses that are there. But so rental properties are really not perfect for everybody. You need to look to see what your other income is and whether the rental property is going to net a loss or is going to net income. You always can get the increase in the value, which is a good thing. And so a lot of people will go ahead and buy even though they're not able to deduct the losses because they're getting the appreciation in the rental property. The 50% of the time and the greater than 750 hours is a caveat for anybody that's spending 50% of their time or more than 750 hours managing the property. You can make it not a passive loss, but it would be an active loss. And then you're not subject to the $25,000 rule. So real estate agents a lot of times use this because they're managing property, they're in real estate all the time, and they can meet 750 hours per year of managing real estate. So flipping and rental properties are good things for real estate agents, even though they might not be good for a typical taxpayer. Next thing we're going to talk about is like-kind exchanges. They're still around. They've been kind of changed a little bit in 2018. Currently, like-kind exchanges can only be done on real estate. In the past, you used to be able to do them on cars and other properties, but for now, unless the new administration changes the law, they can only be done on real estate activity. And it needs to be done on this properties of the same nature. So you can't take your rental property, residential rental property, and buy a commercial property with it and do a 1031 exchange. And what a 1031 exchange is allows you to take the gain that you incur on the sale of the property and switch it over and defer it and roll it into the next property that you buy. There are strict rules regarding the timing of the transaction, so you want to make sure you're working with an escrow agent that understands those timing, because one date wrong, one extra day that you missed will make the whole 1031 exchange blow up, and you'll have to recognize all that gain that you were trying to avoid. Next one. Next, we're going to talk about the laws that went into effect this year for COVID. It was called CARES Act. One of the things that it allows is up to 80 hours of tax credit for individual employees that had COVID exposure so that they could quarantine or take care of somebody. So most of you are not employees of anybody. You have your own company, your sole proprietorships. I want to make sure you're aware of this because on your personal tax return, you're able to take that 80-hour tax credit on your personal return. So you need to refer to your tax advisor, make sure that they are taking that credit for you if you are not an employee and you're self-employed. There is a family care credit that'll allow for an additional 10 weeks if you're taking care of a child, but it has to be a child under the age of 14. The credit was due to expire on December 31st. They just extended it to March 31st, 21. So what this whole thing does is allow you, if you were required to quarantine because you thought you had COVID, or you actually had COVID, or the government agency told you to stay home, which all of us in California had. So everybody really qualifies for this 80 hours of tax credit that the federal government reimburses you for. Another thing that the CARES Act allowed is early distributions from IRAs without having the penalty. So currently, if you take a distribution from an IRA and you're not 59 and a half, you not only pay tax on the distribution, but you have a penalty. And the penalty for the federal tax returns are 10%, and the California is 2.5%. However, with the CARES Act, they waived the penalty. You still pay your income tax on the distribution. However, you don't have the 10% penalty. California has nothing like this, so you would still pay the penalty on the California return. It also allows you to recognize the income over 3 years. You don't have to recognize it all in the year that you took the distribution either. So that's a good thing. It also allows you, if you want to repay the distribution, to return the money to your IRA, you can do that over 3 years. So all of this was meant to allow people more flexibility in getting access to their cash, because people were really struggling paying their bills and had their cash tied up in retirement accounts. So this allows you to take the money out, pay your bills, and then when the economy recovers, if you want to, you can repay it back and have no harm, no foul. There is another big benefit for people this year. Typically, cash donations or donations to charities are deductible only if you itemize. However, with the CARES Act, they did allow a $300 above the line deduction for cash donations only. And this is scheduled to continue for both 2020 and 2021. It has to be cash donations, and you don't have to itemize in order to take this deduction. Another big benefit with the CARES Act would allow you to pay off student loans through a business up to $5,250 per year. So if you have student loans personally and you have a business, the business can pay up to $5,250 toward your student loans. The business gets to deduct that $5,250. The individual doesn't have to recognize the $5,250 in income. So check with your tax advisor. This is a new thing that has just come out. It's good for both self-employed people and people that have a standalone SCorp. Next thing I want to go to is the PPP loans. I'm sure everybody's heard about them. I'm not sure if everyone understands how they work, but the first round of funding, the way it worked was you took your average monthly 2019 payroll and or your net income if you were a sole proprietorship, you multiplied that by 2.5. And that was the amount that you could get funded for. There is still money available for the first round if someone missed and not getting that PPP loan. So you can go to the bank now and get a first round loan and then spend that money and then come back for a second round loan if you qualify. You had up to 24 weeks to spend the money that you received on your first PPP loan on payroll, rent, and utilities. Because you really were getting 2.5 months worth of payroll dollars and you had 24 weeks to spend it, there was really no reason for anybody not to spend it all correctly and get forgiveness. However, the requirement was that 60% had to be on payroll. You could have 100% of it paid on payroll and get forgiveness. The forgiveness forms are available now at different levels, and there's different forms for each one. There is a 3508 form, there's a 3508 easy, and then there's a 3508S form. The easy form is for sole proprietorships. The S form is for people that had less than a $50,000 PPP loan. And then there's a full-blown 3508 form. The SBA is due out with a new form. They haven't released it yet. It's due out any day now. That allows people that have loans of more than 150,000 to provide no documentation and or less. Yeah, if you have less than $150,000, you provide no documentation. You sign a form and your loan is forgiven. If your loan is more than 150,000, you do have to provide documentation. And there's a couple other tests that you have to do on your FTE count, your full-time equivalents, to make sure you have the number of employees that you need and the average wage amounts. Go ahead. Don't have any in my practice. I don't know if any of you know, but if there is more than $2 million on the PPP loan, you do need to provide more information and you need to prove that you really needed a loan to begin with. Go ahead. There was some confusion initially on what forgiveness meant. Initially, the IRS took the stance that even though the loans were forgiven, the deductions that the loans were spent on were not going to be deductible. With the new law that passed December 27th, it was determined, or the Congress said, that forgiveness meant that it's tax-free and not repaid. So this is a great benefit for all small businesses. You do have 24 months from the date of funding to apply for forgiveness. So there's plenty of time to still do it, but don't wait too long. The PPP Round 2 that's out there now, banks are now starting to process those applications. They were out last week for small local banks. The bigger banks are now able to do it. So you just got to be careful who you're dealing with, if it's a local community bank or it's a bigger bank. Most small businesses will qualify. However, there's confusion in the market. The SBA, the way the rules are written, is that you needed a 25% drop in your gross income for quarter 1, 2, or 3 when you compare 2020 to 2019. However, many banks, as they're reading this, and that was the rules to get forgiveness. Many banks are reading it that that's the rule in order to get the loan. Unfortunately, the banks are the ones controlling the loan, so whatever they say is going to go. So just be aware that some banks require you to have that 25% drop just to qualify for the loan, where some banks might give you the loan and you might just not qualify for forgiveness unless you have that. The way you do it, you can look at either 2019 or 2020 numbers, whichever is higher and is better for you. You take the average monthly payroll or average monthly income from a sole proprietorship times 2.5. If your NAICS code starts with 7.2, then you get to multiply it by 3.5. The NAICS code that starts with 72 is the hospitality industry. So it's your restaurants, your hotels, those kind of businesses do get 3.5 times their average monthly. The other businesses out there get 2.5. For forgiveness, we need to go back a second. Yeah, we talked about the 25% drop. Applications are being only accepted till March 31st or when the fund's exhausted. So make sure you don't drag your feet. The first round of PPP money did get exhausted. They had to come out with a second tranche of that. So you don't want to be delayed if you think you want that money. Go ahead. So the entity choice for a realtor, how you want to be structured as a business. Do you want to be a sole proprietorship, partnership, or a corporation? And there's 2 reasons to set up an LLC or a corporation. One is for liability reasons. So if someone sues you, they can't go after your personal assets. The second reason is for tax purposes. My general rule of thumb is that if the net income, that's after deductions, so gross income less deductions is net income. When the net income from a business or a real estate company is more than 50,000, it's time to start looking to do an S corporation. You can save some money in payroll taxes. The issues you want to consider when you're choosing your entity choice, the personal liability, if someone sues you, self-employment tax. We can sometimes eliminate some self-employment tax when you set up an S corporation. However, you need to be aware that that's what's funding your Social Security when you retire. So you may not want to decrease that number. There's California franchise tax of $800 minimum that you have to pay each year. It could be more. You have to prepare a tax return for the corporation or the LLC, and you do have to have payroll if you have a corporation. Forward. Just a few miscellaneous items. The first-time home buyers, IRA distribution, you are allowed to take a distribution from an IRA of up to $10,000 in a year if you're buying your first-time home. You still pay income tax on it, but you don't pay the 10% penalty that we talked about earlier if you're under 59.5. So you might want to keep that in mind for your clients. The solar tax credit is still available. It's been reduced down to 22% for 2021. If you recall, it used to be 30%. 2020, it was at 26. For this coming year, 21, it's 22%. The big advantage of great credit, but it is a non-refundable credit. If you don't know what that means, you might want to talk to your tax advisor to explain it to you, because some people get burnt on that. If you ever have an address change, you want to make sure you notify the IRS and the FTB, the Franchise Tax Board, with Form 8822. If you don't notify them with that form, they will send any notices to you on the address that's on the return. If your mail is not forwarded to you anymore after 6 months, then it's your responsibility that it's your fault that you didn't get the notice. So it's always important to do address changes and notify them of your change of address. Next thing. There is a new program out there. If you're really leery about giving your Social Security number out for W-9s, 1099s, or you just don't want your Social Security number floating out there on your tax returns all the time for refinances and things like that, there is a way that you can get a PIN, a personal identification number, through the IRS that will allow you to stop using your Social Security number on your tax returns. You use this other number instead. You might want to look into that. And then the just last rule I want to leave you, the general rule that the IRS use is that all income is taxable unless it's specifically excluded by tax law. So when you're always worried about, is this taxable, is it not taxable, unless it specifically says in the IRS code that it's not taxable, it's taxable. And I know we went through that very quickly. I'm sure there probably are a few questions.
Good afternoon again, everybody. My request for questions is if you could raise your hand in the participant panel, and then we will call on you based upon your place in line. They can raise their hand, right, Justin?
Yes, they can raise their hand. They can also put it in the chat as well. So if they want to, actually might make it easier to put it in the chat, so that way we can read off the questions that way.
That would work as well. Don't everybody storm the castle.
Like Charles Yazzo.
Charles, could you unmute yourself and ask Kevin?
Yeah, Skip Yeazel. I thought it was in California we could not use an S corporation for real estate business.
That's not true. I have several real estate agents that are using SCorps.
Great. Okay.
Jason Allen, you had a question for Kevin? Please unmute yourself.
So could you please explain in greater detail the 80 hours of tax credit? What does that mean?
So if you're, again, I think everybody qualifies for this. If you had to quarantine because it was government mandated that you had to quarantine, or if you had COVID and you needed to quarantine for 80 hours, or you were taking care of somebody that had COVID and you needed to be quarantined, you can get, the federal government will reimburse you for 80 hours of your time if you're a full-time employee. If you're part-time, then you have to prorate it based on how many hours you work. So for sole proprietorships, which I assume most of you are, the way it would work is that you would take your income that you earned from March 27th through December 31st. So basically 9 months of your year, and divide it out to a daily rate. And then as long as that daily rate is below $511, you get to multiply that daily rate times 10 for 80 hours of credit. And then that will just be a credit on your personal return.
Off gross, like it's just a deduction?
It's a credit, not a deduction. It's off a tax.
Okay, got it. Thank you.
Better than a deduction.
And Kevin, we have a question from Frederick De La Rue. Kevin, in automobile deductions, could you talk about deductions when buying a new car, SUV versus sedan versus lease?
So the first thing you want to look at when you're buying a car and putting it into the business is how much percentage of the car is used for business. General rule of thumb is it needs to be more than 50% business use before you want to buy and put it into a car, into the business. Once the car is purchased into the business, the wonderful benefit of that is there's something called Section 179 expense and bonus depreciation, which will allow you to write off immediately the whole entire cost of the car and the year that you acquired it. You don't have to do that, but that's an option to do it. It can only be done in the year of acquisition. And if the car is owned, then you would also be deducting the interest, if you have a loan on it, you would deduct your gas, your repairs, your tires, all that kind of insurance. But you do need to reimburse the business for your personal miles. So typically what I do is I take the personal miles that were driven and multiply it by the standard rate and reduce the amount of the expense by that number. And then now all that's left is business use. Hopefully that answers that.
I kind of have a question, Kevin. I've always been a proponent of purchasing my car. However, I noticed in your presentation, it said lease is, so if you're leasing a car for your business, it's fully deductible, whereas if you're purchasing, just the interest is deductible. It seems something like that.
Well, so a lease, the full lease payment would be deductible. If you have a purchase, you get the interest only deductible, but then you also get to depreciate it. So the interest and the depreciation is usually more than the lease payment. When I tell people whether you should lease or buy, it depends on how frequently you want a new car. If you're somebody that wants to drive a new car all the time, and so you want a new car every 2 or 3 years, a lease could work for you. If you're somebody that wants to hold the car until it's run into the ground and it's dead, and then you buy a new car, then you probably want to purchase. And the reason for that with the lease, if you're always going to have a new car, you're always going to have a car payment. So you're used to having that monthly lease payment going on. If you own the car, you'll eventually get the loan paid off, and you could have years going on without a monthly payment for the car.
Excellent. Thank you. Jason Allen, you have another question?
I do. With respect to the PPP, if you did receive it, and since you don't have to pay taxes on it, is it like it doesn't appear anywhere on our tax?
On a Schedule C sole proprietorship, yes, you just don't report it anywhere.
It's not there. It doesn't exist. Okay.
If you have a corporation, it goes on Schedule M1 as a non-taxable income.
Okay, thank you.
Catherine Robinson had a question.
Hey, yes. Okay, so and obviously this may require further attention to detail, but with regard to a sole proprietorship versus an SCorp versus a corp, an LLC, how do you distinguish what a real estate agent should actually do for their business, number one? And then with regard to Cover California and being able to, I guess, ultimately pull insurance through one of those entities, how does that work?
So the first thing that you mentioned is when you should switch from being a sole proprietorship to being a corporation. And that $50,000 of net income that I mentioned. So when the net income is above 50,000, there's an opportunity to save some money in self-employment taxes. Below 50,000, you're probably better off staying a sole proprietorship. If you're worried about the liability issues, then you can get an umbrella policy to protect that. Your Covered California issues is all done at the personal level. You can't get Covered California as a corporation. So you would want to be doing that individually. And they would be looking at the amount of taxable income that you have on your personal tax return to see how many subsidies that you're eligible for.
Excellent.
Cindy Stevenson.
Hi, Kevin. This year I left RE/MAX and I incorporated SCorp and I formed my own brokerage. And my question is, in the past, I was issued a 1099 miscellaneous from my broker. And this year I'll be issuing one, I suppose. This is my question. Do I issue a 1099 to myself from my corporation name?
No. So the corporation will be recognizing the income, and you'll pay yourself a paycheck. It's a reasonable salary. And then the rest you'll take out as distributions, but you don't need to issue you a 1099. You'll issue yourself a W-2 because you should be running it through payroll with the corporation.
See, I haven't been doing that. So I formed in October and I haven't done that. I mean, I've not taken any money out of the business. It's all just there.
So one of the requirements of an S corporation is that the officers of the business has to take a reasonable compensation. I mentioned that the way we're able to save self-employment taxes is through this S Corp. The IRS is aware of that. And so they're saying, okay, you can do this and save some self-employment taxes. However, you must take a reasonable compensation and pay some payroll taxes. So that reasonable compensation is a number that you want to debate with your tax advisor to get what's reasonable. You know, your office, the taxpayer obviously wants it to be small as possible to limit your taxes. However, it needs to be reasonable to what you would pay a person to do what you're doing.
I probably need to come see you, Kevin.
I can put his information in the chat before we leave. I had
Okay,
another question regarding LLCs and S Corps, Kevin. Somebody said, do you have to have employees to change from a sole proprietorship to an LLC or S Corp?
No, they're two totally different things. A sole proprietorship can have employees or they cannot. LLCs can have employees or they cannot. The LLCs are something that states created. The federal government doesn't recognize them. So when you set yourself up as an LLC, you have to tell the federal government how you want to be taxed. By default, a single member LLC is a sole proprietorship. If you have more than one member of the LLC, by default, you're a partnership unless you tell them you want to be a corporation. And then if you choose to be a corporation, then you have the option to decide whether you want to be a C Corp or an S Corp. But LLCs are something that people don't understand or really what they are. They're kind of nouveau. They've only been around for about 20 years. So I generally tell people if you're going to elect to be an S Corp anyway, it's better to just set yourself up as an S Corp rather than just setting yourself up as an LLC and then choosing to be taxed as an S Corp. But the payroll factor doesn't really matter. You can have employees or not have employees either way.
Excellent. Any other questions? I don't see any hands. I don't see a chat. Going once, going twice. For the $50,000 and up from sole proprietor, is that net or gross change to S Corp?
Net income. That's after deductions.
Cool. Excellent. Any more questions? Getting a lot of thank you. Jason Allen, if you could direct that question direct to Kevin, that would be awesome. I've left his information in the chat.
Great. Hi, Kevin. I'm just curious, do you have a sense of what an individual agent operating as a sole proprietorship, what tax preparation for that would be? I mean, and I'm not trying to hold you to it, but like, are we talking $500 or $1,000 or
Yeah,
some,
so the way my
sense?
the way my fees are determined for individual tax returns is what each form has a price attached to it. So whatever forms you need to prepare your return, that adds up into an invoice. If you just have a sole proprietorship and you don't have rental properties or W-2s or other K-1s or anything like that, just a sole proprietorship is probably going to run around $500 to $600.
Very helpful. Thank you.
Great. I think we have come to the end of our questions, getting a lot of thank yous. Thank you for your time, Kevin. Excellent. So if there's no more questions, Kevin, I want to thank you very, very much for your time.
My pleasure.
I loose you back to tax season and enjoy yourself. I please everybody, his contact information is in the chat. You're welcome to email him or call his office if you have deeper questions than what we covered here today. But Kevin, thank you so much for your time. I appreciate you. as does the YPN and CDAR.
Good luck, everybody. Bye-bye.
Thank you. Okay, everybody, I do want to mention our next event before we adjourn. Let me find the message here. Okay, we're going to have Riverside Sheriff Chad Bianco on February 18th at 1 p.m. He will be our guest speaker for our Zoom meeting on the 18th of February. And if you haven't seen the YPN tentative schedule of events, you can find them on the website. You can also register for this next YPN event at cdaronline.org at the calendar. So please register for these events. And if you are an affiliate and you're looking for sponsorship opportunities, we are actively looking for sponsorships. And we're just doing one level of sponsorship this year. We're not doing the different levels like we used to do. So we're keeping it simple because we're expecting at least 3/4 of the year to be on Zoom. With that, I thank you all for your time today and attendance, and have a good day.